Hey, Namaste Aditya. How are you? So I got a few things today. So let's wait for others to join, but want to talk about uh, like Morris and I, we were just talking. The markets are doing good. So that's where we see a lot of funky things happening because we believe market is doing good and we put the risk on the side. So I thought a prudent topic to cover today will be risk management. I think I talked about this maybe a year ago or something, but then, we have a new folks coming in here. So I want to revisit it. Two reasons. One is I'm going to play a clipping from a podcast that I was listening to. That was one reason that prompted me to come and talk about risk management. Uh, So we'll do that. And the other one is, hey, markets look great. And when markets look great, no one wants to talk about risk. So I thought,
Hey Vivek, can,
yeah.
can you talk about risk management from the federal level, from the markets level, and from the stock level?
So I'm going to talk about risk management as an individual investor, how we should think about risk.
Okay.
Because most of the risk comes from internally us rather than external factors. So I'm going to go through. It's like
Hmm.
probably that will be the biggest topic today. It's almost 50 slides.
Wow.
I'm going to talk about risk in portfolio, what different kinds of risk that exist. First, I'm going to address at a higher level how we should think about risk. And again, uh, you know, I feel that the foremost and the most authoritative voice on risk management is Howard Marks. I've read all his books. I've probably read dozens of his memos, and I've learned a lot from him around risk management. So a lot of our content comes from that. But I wanted to share because I, you know, I should have had read Howard Marks 10 years ago, 15 years ago. Life would have been much different. So, but it's okay. It's never late. So that's one main topic. The other topic is a continuation of what we have been discussing around fallen angels. So two companies I want to cover today is Intel and Starbucks. And yeah, of course, we'll look at it's a little bit on what's happened in the market and any change on portfolio. So okay, recommend good reading material from Howard Marks. So there are two books. Hold on. Let me give you the URL of where his world-class memos are available. So Howard Marks. So and anytime this memo comes out, I make sure I go and read this. So this is so this is a link where you see, all the Howard Marks memos. uh, let me put the link in the chat. Okay, let me also give you a reference to the book of the most important thing. There's a book called The Most Important Thing. Oops, no, this one. That's again from Howard Marks. Pretty good book. And there was one more uh, I had read, which was, yeah, Mastering the Market Cycle. So let me give you a reference to that. Uh, Other Mastering the Market Cycle. Yeah. So if you don't have too much time, at least go through these memos. These are like 6, 7, 10. Sometimes if it's longer, yeah, maybe 12 pages. But yeah, I mean, a lot of investing community just definitely focus on the memo that comes out from Howard Marks. And if you have more time, in the order of importance, the books that I found it, I think the most important thing, I found it better. I mean, both books are great, but if you have time for only one, maybe look at the most important thing. That book. Yes.
Vivek,
Yeah.
I'll let you see how I look. Vivek, so we like to talk about Rivian, right? In Amazon, but the company I provided at the top, Oshkosh, is providing the USPS of their new vehicles. But the stock hasn't gone anywhere in the past 5 years. Excuse me, in the past 1 year. No, actually, it's gone nowhere in the past 5 years. If you forget, so why is that? Because Oshkosh has a more stable. It's an established corporation, and it's more stable.
Yeah, so I think the stock is back at where it was in 2018. You're right that yeah, 2021 or 2018 hasn't gone done much. So if you really look at it, it's like 10 billion sales and 682 million, half a billion income. And yeah, they do give a dividend. What's their operating margin?
Is it not sexy? That's why people don't want it. I mean, they got to definitely and they also are in defense.
Yeah, so the problem with the defense stuff is that you don't have much of a pricing power.
Oh, okay.
So if you're in a defense one, when you're dealing with the government, you don't have much of a pricing power because most of the defense contracts in past, if for decades, have been cost plus, right? So whatever is your cost, you just add a little more, margin to it, and that's it. So you don't have much of a pricing power if you're only focused on the defense side. And that was one of the reason, to go back our discussion around Palantir, I said, hey, unless I see their commercial revenue growing, I can't go really big on Palantir because, hey, if it is only dealing with the government, they don't have much pricing power.
Oh, excuse me. Last night I saw on what's that? Bill Mayer. I threw in a tweet. There. After I watched that, I'm totally sold on Palantir, but I'm not going to buy a stock that's $30 or $50. That was very good.
Yeah, I mean, I have heard Alex Karp, I mean, right from his very early video, and I kind of like what he was talking about it. Of course, most of the Silicon Valley, was thinking different, but yeah. And then they build the product. Again, when I saw their commercial revenue growing, that's where I said, okay, I think then it deserved to be in portfolio. All right, so I guess let's get started, guys. What else? Anything else on your mind before we get going? Okay, let me share my screen. Okay, so this is where I have all the Howard Marks memos.
Because Palantir also does defense. Actually, what he says is they cover everything. They cover everything, and I was really kind of astonished. That's why the interview was so. I mean, it really hit me.
Yeah, I mean, they started with the defense. It's been almost 20-year-old company. They started with defense, but if you look at their demo and the product, I mean, I was so fascinated by in terms of how easy it was, at least in the demos. It was like how easy it to do the analysis, and especially the Gotham, etc., which is all related to the defense, but they also find the application in the commercial side, right? So, And that's where over the last 3 or 4 years is where their commercial business has started to grow in. And I'm still bullish on it. I'm not saying that the stock may be at the right price. That's like on an individual basis. But as a business, I'm still bullish on it because, it has a capability to be the de facto SAP of the new generation, right? If you know what I'd say, like SAP used to be, like if you are a manufacturing concern and you don't have an ERP system, maybe SAP, then you're kind of a dead in the water. That used to be the case like 15 years ago, right? When I started my career on the tech side, I know how much a SAP consultant used to mint money, right? The license fee on the SAP and the professional services fee on the SAP would be 50 times the license fee. Now, Palantir could be the next one, which could become the, your own new kind of ERP system, which every company might need. The way they have been addressing different kind of problems. And if you want to go through it, maybe if you have a time, I have a hard stop at 12:15. But if you have a time, I actually went through they had their 5th version of AIP Con, which is a conference that they do, wherein the customers come and talk about how they're using Palantir products. So I went through the whole 2.5 hours and consolidated my thoughts around what customers are saying. So maybe we'll go through that tweet. I also tweeted about it. But yeah, I'm still bullish on the stock. And good thing is that the markets are stay volatile. You get an opportunity to buy the stock I bought it at $26. I think that was my first purchase, 26, 27. Then I bought it at $6, $7, $8. Now I think the stock is at 35. But yeah, if you follow the company and read about, follow the business of the company, then if market gives opportunity, then you can make use of it. All right, so I guess let's get started. We have 10 folks waiting in here. Others will join when they want to. So let's jump into today's session. We're going to talk about, like I said, risk going to be the most important thing for today. But we'll also look at what happened in the markets. So this was last week, like weekly performance. We talked about it. The markets are down. Kind of reminded us of the first week of August, where S&P was down like 5% in first week of August, or close to 5%. I don't think it was down 5%, but anyway, that was a yen carry trade that unwinded, and not just US, but also the Japanese stock market. I mean, Nikkei fell on what, 10+%. Anyway, so we also had the same kind of a first week of September where the stock was down like 4%. Generally, September is if you go back in the history of the stock market, September is a tough one, little more volatile, and markets are not that good for the markets. But in the first week itself, S&P was down like 4%, which is like, you could say, hey, did we get all the downside of September in the first week itself? Anyway, a week doesn't matter, and we bounced back this week. So I'm like, except I guess energy, everything else looks okay, right? Everything else is green. So that's why it is important to stay in the market. You never know when the market comes back. So we had a Microsoft up 7%. Now we are talking about these companies, which are what, 2 trillion plus companies. Nvidia up like 16%. 16%, a $2 trillion company. Meta up almost 5%. Amazon up 9%. Tesla is like 10%. Financials generally up, except Berkshire Hathaway. Berkshire Hathaway was, it hit $1 trillion. And if you following the news, the Ajit Jain, who is the head of their insurance business, and insurance is the money maker, it's the one that provide all the fodder for Berkshire to invest in other companies. And the head of insurance, Ajit Jain, he sold half of his holdings in Berkshire. So market is also thinking maybe I think Berkshire is fairly valued, which looks like because Berkshire also reduced the amount of a buyback that they do. So, and after hitting $1 trillion, now it's back. I think Berkshire had hit 480 or something as its BRK. Yeah, 484. And now it's back to 450. Right. So I think if you look from what Buffett metric is, what he considers as a fair value at which he'll be okay to buy back the shares, it's like 1.2 price to book, right? And right now Berkshire is trading at 1.6, so it's okay. Other than that, like markets look great. So if you've been in the market, stay in the market. Time in the market is more important than timing the market. Sam says I bought Xiaomi last week as a penny stock. Okay, you do what you want to do. I don't believe in penny stocks. Palantir will join S&P in September. History says it could soar afterwards. Motley Fool. I know because last week we covered what's coming in S&P 500 and going out of S&P 500. So that Palantir joined S&P 500 along with Dell was another company that joined S&P 500. Etsy came out and few other companies came out. So yeah, there is something tailwind from if you join S&P 500, then there are many passive ETFs, mutual funds who just buy S&P 500. You get some tailwind from there on your stock price. But I think long term doesn't really matter. We have seen it in Tesla was up 20-25% after an inclusion. Many companies went through the same route that either before inclusion or maybe a few weeks after inclusion in S&P 500, you'll see a share price just jumping up. And then eventually all that positive movement from inclusion in S&P 500 will, it will give back and go back to really trading on how the business is. So yeah, it's a great moment. And I think it's all, if you go to a YouTube video and look at Dr. Karp address to after inclusion S&P 500, yeah, it's a big moment in the history of the company, which first of all, market didn't believe in the company. They said whether it will ever make money, whether it will even survive, because they were kind of a anti-VC stuff. So yeah, they were like swimming against the tide. So didn't know whether the company will survive or not. From there to being cash flow positive to being GAAP positive, operating cash flow positive, and now inclusion into S&P 500. I think that's a big moment for any company, right? Not just Palantir. So it gives you some stamp of approval from the biggest market in the world. Xiaomi is Hong Kong listed stock, but US ADR is cheap. I don't know. I've not looked at what's the ticker for Xiaomi?
Oh, Vivek, you don't have to spend time on it, but the thing is, it's a very good company, and the only reason I mentioned penny stock, it's like $2 or $3, and it's kind of like I don't know, it's kind of like Panasonic with a Google dude as leader.
Okay. Oh, maybe the Finviz does show the ADRs. I don't know why the Finviz is not showing ADRs. Yeah, I've not looked at the company.
Well, because I'm a user. That's many of my stocks. I'm not a user, but I'm a user of Xiaomi, and so
I know. I mean, it is like one of the top selling phones in China. Now, Apple is number 6 in terms of the number of units that are being sold in China. Xiaomi, Huawei.
Xiaomi doesn't earn money.
Oh, okay.
They're a bargain basement company. They don't earn money.
Yeah,
It's very
I
cheap.
would be interested.
Yeah, that's what I'm telling you. But the guy's a genius. So, bidding on that.
All right. Other interesting chart, which is around, looks like investors just want tech and only tech and only tech, right? So that means also the risk in the tech continues to increase. So this is talking about in 2023 when Fed paused. And since then, the tech sector, after Fed pause, all the non-tech sector after the Fed pause, right? Or if you're looking at October low, the gap between the inflow into the ETFs, right? So the tech ETFs, QQQ, XLK, the amount of money that is flowing into the tech ETFs and the amount of money that is flowing out of the non-tech ETFs, the gap. So basically the gap is just keep on increasing. Looks like everyone wants just tech. I don't know. Is it 1997? Is it 1960s? But the more this gap continues to increase, the more is the risk that is going to be inherent in the tech sector. And I'm saying this, even though most of my holdings, I still hold majority of tech stocks in my portfolio, but you gotta, at some point of a time, you gotta look at it and see how long will this continue to, money will flow like this. But it is what it is. I think right now the tech sector is what, maybe 40%. So a lot of a concentration coming from tech sector. Nothing new. We also looked at a historical concentration. It's not the first time that a particular sector, or let's say the top 10 companies have become like 30% of the S&P 500. It has happened in the past. Just that over the last 2-3 years, the speed at the rate at which the concentration has increased, that has been much more than the historical, and hence it looks like, oh, we are too heavily concentrated. What other interesting chat? CPI numbers came out this week, so we are better. We've kind of much better than how the numbers were at the start of the year. This is CPI change, percent change from previous month. So we were till June, month over month, we were decreasing, and now in August, we actually increased if you look at from month over month. So, but year over year basis, annual basis, the core inflation is still at 3.2%, still higher than where the Fed would want it to be, which is like 2%. But if you dig deeper into the constituents, the composition of this core inflation, I think it's mostly because of the shelter. So it's related to your real estate rent and home prices. Those have increased 0.5% versus the previous month. If you take that out, inflation, we're doing pretty good on inflation. So, and if you're doing pretty good on inflation, then market is just waiting for Fed to, cut the interest rate. Because what else? If the inflation is under control, except one of the category, which is like rent, everything else looks like your used vehicles, personal medical care, recreation, home furnishings, etc., all look good. And now market is waiting for the rate cut, expected to be announced this week. The coming week, I think it's 19th or 20th, whenever the FOMC meeting finishes. I think generally it's on the Wednesdays. So we should hear from Fed official Jerome Powell talking about the rate cut. Now the question is it going to be 25 basis points or is it going to be 50 basis points? That's the question. I think I'll be really, really surprised and the market will be shocked if we don't get a rate cut. So interesting thing, I went back and looked at the probabilities. Okay, I think I'll have that later. Okay, so this chart again shows the same thing. If you're looking at excluding shelter prices, we are back, we are below like 2%. We are below the Fed levels. We are below the pre-pandemic levels if you exclude the shelter pricing. Core inflation in the last 4 years, significant progress have been made from 6.3% in August 2022. In last 2 years, we are now 3.2%. Still some work, but everything moving in the right direction. This is core inflation in 1958, year-over-year change. We're looking at 3.2%. This was an anomaly from, I guess, 2000 all the way to last 20 years has been an anomaly. We hardly had any inflation. I think it is because of China. Even though, China was supplying the goods to the world at much cheaper rate. And that's why we didn't have that much of inflation. Once we brought China into WTO and, started buying and basically outsource all our manufacturing to China. And that reduces the prices of almost all goods. Of course, there are other impact that we have had, and I think COVID had laid bare all the other impact of outsourcing everything. So now we're trying to bring back some of the manufacturing. But that means we also have to be ready with little, higher inflation than what we have been accustomed to in the past. So you're not going to get back to, 2%, or if we want to bring the manufacturing back to US, unless everyone is willing to take a huge pay cuts. So that's on the inflation side. Yeah, this is what I wanted to show. So at the start of the week, I was looking at the chart and there was like 17%, 17, 15, somewhere over there, chance of 50 basis points. And today morning, I looked at here again, and it says now 50% chance of 50 basis points rate cut from Fed. So, which is, I don't know, whatever happened this week, maybe I think it's an inflation number. And that's the reason why we saw market ripping back up over this week is, hey, we're going to get those rate cuts. And probably we're going to get 50 basis point rate cuts. Me personally, I'll be a little scared if you get 50 basis points. But what do I know? So right now, there is a probability of 50 basis points has reached almost 50%. This is crazy. I think we should just get 25 basis points. Anyone like waiting to get 50 basis points? Hoping you get a 50 basis points? Anyway, so looking at a sector-wise performance, S&P 500 is almost at a near, I think, all-time high. All-time high, I guess, was close to 565. SPY. Yeah, 565, and we are pretty close to that. So yeah, markets are higher. And you look at the utilities, 23%. Communication services came back up. Industrials, material, staples. Now those the dividend paying stocks are now ripping back higher because, hey, if Fed is going to cut the interest rates, that makes the other dividend paying stocks a little more attractive. So that's two reasons why utilities are all up is number one, they pay dividend. Number two, we'll need all that extra energy for running AI models. So that's the reason why the utilities sector has been ripping higher. Energy, not that much. That's a sector which has not been performing. It's all because we can blame all that on China. Yeah, I think we all can agree, whether you're on the right side of the Congress or on the left side, or we all can agree to blame everything on China every time there's an issue. And we can blame the dismal performance of energy sector on China because, come on, the economy of China is not picking back up. But Chinese market hasn't done anything over the last 5 years. So let's go. I think that's what I heard. Let's look at FXI, which is large cap China ETF. Let me pick a 5-year one day. We're back here. Okay, 20 years. So it's back up to here. This is FXI large cap. So which is back to where it was in 2022. Not 5-year. Maybe they were talking about the overall CXI or CSI. But anyway, so the whole blame game around the energy is China's economy is still dicey, even though the government is trying to prop up the economy by various means. They're loosening some restrictions around investment in some sectors. I think the latest one I saw was in a healthcare sector, and I guess there was one more sector where they'll allow more investments, less restrictions. And of course, China is also trying to prop up their real estate, which has been in doldrums almost last 2 years. Evergrande, the reality that the big whole bankruptcy of Evergrande, and I think there were other couple of big real estate players. So a lot of wealth of Chinese population was stuck in the real estate, and they're feeling the pinch. They are feeling the pinch. A couple of comments I'm seeing. Sam is saying the US began sourcing goods from China significantly after the normalization of diplomatic relationship between the two countries in early 1970s. Yeah. But I think we inducted China in WTO somewhere in maybe 1990s.
Excuse me, that was wrong. That was POAI. It's 1980s.
Okay. I remember I was in college and there were a lot of of course, I wasn't following the markets, but I remember China and WTO, seeing some headlines around that. Ramesh is saying selling tech-heavy holdings now will have to pay capital gains, and lack of diversification could get you in trouble. Yeah, it's like you're kind of stuck between the rock and the hard place, right? If you sell tech-heavy, are you gonna get hit with a capital gain tax? So that's why I do a negative delta trades, use QQQ to kind of a hedge risk against my tech holdings. I don't have to sell my tech holdings, but I'm selling calls, or you can do a callers against QQQ. That's what I've been doing. So throughout this year, most of if you look at the number of trades, I think the maximum number of trades I have is in QQQ. One of the earliest major US corporations to invest in China was Coca-Cola, 1979. Bobby is asking, do you still recommend investing in China? China is cheap, but I still hold China, the equities related to China, but my position size is you have to size it accordingly. So the biggest lesson is position size. If China is 1%, 2%, 5%, 10% of your portfolio, if it goes down to 0, you still have rest of the 90%. But if it is 50% of your portfolio, it is difficult to come back if you lose 50%. Right? So it's more about position sizing. Yeah, the Chinese market is, as compared to the rest of the world market and the US market and the India market and the Brazil market, it is pretty cheap. That doesn't mean you can back up the truck on it, because stocks that are down 50% can also go down another 50%. Same can be said about the country markets. And on top of it, you got a country risk in China. I don't even know. Maybe what if Chinese government wakes up a day and say, okay, today let's go to Taiwan. And then if US government decides to do what they did with Russia, saying, okay, all the Chinese equities needs to be delisted, there you go. All your investment goes to 0. So that risk, I don't know. I mean, no one can put a number on that risk. So position size is a lot more important when you're investing in, Chinese market. Is it cheap? Yeah. Can it go to 0? Or can you be, as a US investor, can you be, taken out of the Chinese market? Yeah, there's a possibility of that also. And I don't know. I don't have any number on the probability of what that could happen. Right? So you got to be careful from that perspective. What else? So we are up almost 18% for the year. This is on top of 26% in 2023. Too much gains too soon. Another chart, I think we have talked about these numbers now multiple times, which is how the stock market have performed after the rate cutting cycle has started in a non-recessionary environment, which is where we are today. Market doesn't look to be in a recession. And still the Fed is cutting rates because, hey, they can afford to. Inflation is under control. Little bit challenge on the labor market side. So they are not cutting the rates because they really, really need to prop up the economy because the economy is in recession. They're cutting the rates because they can, not because they have to. And looking at the previous cases where they cut rates because they can, 1996, 1 year later, S&P was up 19%, 2 years later, 34%. 1998, S&P was up 23%, 2 years later, it was up 40%. So if we think we have too much of a gains already, just keep these numbers in mind. Right? I'm not saying back up the track, but hey, you never know. Markets have been, the stock market has been the vehicle for generating wealth, and this is why it is. Don't just go out of a market. You never know when it is too highly priced and when it is too lowly priced. Right? So I'm just going to still stay in the market, just sharing some numbers. What happened to the fear and greed index? We're back into neutral from the fear of the last week that shows up in the market. S&P wise almost near all-time high. So what changes have happened in my portfolio? I bought ASML. I think I tweeted about ASML. Also, when the party and maybe I'll share the reason why did I buy ASML. And these are the stock purchases. So let me just share with you on why I bought ASML. Where's that tweet? Ding, 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 ding. Oh, come on. There's so I added to my ASML position on whatever September 10th. As you guys know, ASML has got a monopoly over EUV system. Stock was beaten down and its forward PE was less than 10 year of average PE. Stock got beaten down because of restriction that Dutch government said they're gonna, add in more restrictions, like US has been requesting their allies. But it's a high quality business, right? 30%, more than 30% ROIC for 5 years, more than 20% average for last 15 years. Cash flow generating machine averaging more than $5 billion free cash flow for 5 years. And we know semiconductor is generally a cyclical industry. So you just can't look at like last 5 years and say, hey, semiconductor has been moving up, and hence that's why I go back to look at 15 year, 20 year. It has gone through rough weathers and it has still generated decent ROIC. And the stock was available at very cheap. I think it was 745 or between 745 to 750. I thought, okay, you know what? That's a good price to own. And the TSMC came up with their August monthly revenue. So TSMC is a company, TSMC basically provide monthly revenue updates. I think if you are listed in Korean exchange, unlike in the US where the companies have to provide quarterly data, if you are a Korean company, you have to provide monthly some data. So that's why TSMC provide monthly revenue. If you look at August revenue, it was up 33%. Right? And why is TSMC revenue up 33%? Because there's a demand for chips. So that the demand for chips has not gone dead yet. So I thought maybe it's given a risk reward. I added to my ASML position this week. So that's the reason why I added ASML.
Vivek, so this 1 year, 3 year, is it forward looking, those numbers, or the
No, those are
backward?
all history.
Oh, it's a history. Okay, thank you.
It's a history number. So Google, I had a short put spread at Google, and that was like deep in the money. The short put was deep in the money. So I got assigned, and so I should say that was a short put assignment. I still hold the long put leg of the short put spread. So I'll probably, sell that and keep some of the Google shares in my portfolio. But those are the only two new stock additions that I had in my portfolio for this week. I swear no sells. So from this week, I thought I'll also share some Hall of Fame and Hall of Shame. So that this week Hall of Fame, and my definition of Hall of Fame is the stock that have hit new 52-week high in portfolio. Mercado Libre, Palantir, GLD. Gold is outperforming S&P 500. Can you believe it? So we know SPY is up 18.91% for year to date. Look at GLD. That is up like 25%. So handsomely outperforming S&P 500. Yeah, it didn't do anything for 10 years until 2022. And now after that, from 2012 to 2022, gold didn't do anything. And I think all the gains have come in last 2 years. So yeah, GLA hit a new 52-week high. INDA, which is India-based ETF. TLT, the bond ETFs. Now, because the Fed is going to cut interest rates, everything related to the fixed income, these bonds or the companies that pay dividend have started to, move up. So TLT hit a new 52-week high. Look at TLT. This week they hit a new 52-week high. Let me go back to 1 year. It's 1 year, 1 day. At 101.24. What else? TTD, the Trade Desk, Coupang, Doximity. Hall of Shame, Boeing. Boeing hit a 52-week low. All the troubles that I don't think. I hope this is 20. Let's make sure all the troubles that Boeing has to go through, they go through in 2024. And hopefully 2025 will be better. The most recent trouble is a strike. I think first in last 16 years or something is the first time that some 30,000 workers machinists have they've gone for a strike. They called a strike and not working. So obviously it's going to have a financial impact on Boeing, because you can't get the parts for your planes, then you can't build those planes, and you can't deliver those planes. So let's see how it goes. They got a new CEO. We'll see if he does anything different. But I guess Boeing has been on a Hall of Shame wall, and it is one of the biggest one on Hall of Shame wall in my portfolio. The other one which hit again 52-week low is Intel, INTC. I think there's a discussion going on in the board, and they've also got some Wall Street firms to look at maybe restructuring. We'll see what happens. But that hit another 52-week low. Intel is now trading at what, $19 or something? Yeah, close to 19. But 1851 was its 52-week low on Intel. So we're going to talk about Intel in Fallen Angels anyway. I see a question. Can you please review QQQ trade for this? Thanks. I sell covered calls and sell put close to the strike price to buy a discount if assigned, or keep the premium. So what trade do you want me to review? I'm not mentioning it. So you're saying you're selling a covered calls. So this is, so basically you're selling a strangle against QQQ. I mean, that makes you bullish. If the stock goes down, you're going to add more deltas on QQQ. I don't, because I already have a lot of tech in my tech stocks in my portfolio. I don't do positive delta trade on QQQ, or maybe just to if it goes, too much, or my short calls become too much in the money, then I might do it as a trying to manage that. But otherwise, I just sell covered calls. So you could still do strangle, but depending on whether you want a positive delta or negative deltas, you have to skew your strike prices accordingly. Say you can do a short put at 16 delta and maybe do a covered call at 30 delta. You still get negative 15 deltas, right? So, and I don't know about your portfolio, so I don't know how much negative deltas you should have in QQQ, but I only can talk about my portfolio. I have, try to maintain negative deltas on QQQ. And which means if the tech is ripping higher, I'll probably gonna underperform the market because I have hedges. There is no free lunch. But if the trade unwinds, that's fine. I'm not gonna hurt that much. I will have these hedges play out, which I think the September month, the first week of September, I think even for this week, they're done so far pretty nice. So that's how you can decide how much of a negative delta you want on QQQ. All right, let's talk about the most important thing. And the reason why I wanted to talk about that, probably gonna spend 30, 45 minutes, depending on how many questions you may have, is about the risk. It's not the sexiest topic. It's not where, I can tell you, hey, you're gonna 2x your money. But I think this is what keeps the people in the game. And the most important thing when it comes to investing is just don't blow up your portfolio. You don't have to find great investments. You just have to make sure it's a negative art. You just have to make sure you don't do bad things. Because market anyway has a positive tailwind. You don't have to try to outperform the market. Just make sure you don't do stupid mistakes. And that's why the risk management is important, that we don't do a stupid mistakes. That's all. We have to avoid doing stupid mistakes. You don't have to find great investment. You just invest in index fund and don't do stupid mistakes. That's good enough for us as an individual investor. Carl Icahn. I heard about him on a podcast. That's where I thought, hey, maybe I should go back and revisit the risk management. So anyone needs introduction to Carl Icahn? Everyone knows who Carl Icahn is? Anyone don't know Carl Icahn? All right, so let's talk about Carl Icahn. I think now he's almost 80 years old. He is, depending on which side of company you are, some people hate him, some people love him. A lot of books have been written on, on Carl Icahn. The one which I have read, and I really love the tussle between these two hedge fund guys, is When the Wolves Bite. The first one by Scott Wapner. This is talks about the history of the animosity between Bill Ackman, Pershing Square Capital hedge fund manager, and Carl Icahn. Carl Icahn is considered as an activist corporate raider and a fearsome raider in, let's say, 1990s, 1980s, 80s, 90s, right? I think there's a movie, Barbarian at the Gates, probably has been I think that movie was it Carl Icahn or someone else? It was RJR Nabisco. Who was involved in RJR Nabisco? Anyway, so he's a corporate raider. Basically, they'll buy company shares and try to change the board, and has done himself very well for himself. In 2015, his net worth was $25 billion. And I know in one of my previous company, Carl Icahn took a stake in our company, and then that point out, it was like 4 years ago. And I told my colleagues, I'm like, we not gonna be a a public company for long, because we know, if you look at a history, we know what his playbook gonna be. He's gonna cut cost, he's gonna bring in new management, and then he'll try to figure out to sell its stake or become private, etc. Because that's what he'll do. And that's exactly happened. Our CEO was out. A lot of our folks at the top end got changed, and the company was taken over by another private equity company. Carl Icahn sold the company. So, and then of course, some of the things happened after I had left the company. So I got a message from my colleague. He said, "Hey, you told that 18 months," because I told him, give us around 18 to 24 months. We're not gonna stay as a public company anymore, and the leadership will change, because you know how the playbook of Carl Icahn is. And I think that happened around 16 months after they took this thing. Anyway, so, and he's done great for himself. $25 billion net worth in 2015. Not anymore. So I want you to listen to this podcast, which is basically prompted me to come and talk about Carl Icahn. So I guess this is maybe 5 minutes long chat, but give it a listen. Then you'll appreciate why I want to talk about it.
About Carl Icahn. This is the most shocking story of 2024.
Is the voice okay? Was it audible?
Yes.
Yes.
Okay, so let's listen to this.
It's sort of under discussed, right?
Under discussed. 2 years ago, there was an HBO documentary about Carl Icahn. He was literally at the top of the world. And they don't like, HBO does not do documentaries on anyone other than Warren Buffett and Carl Icahn. Like, they don't cover finance. But his story was interesting enough, and he had been successful enough that they wanted to do something on him. It's been nothing but a shit show ever since for this poor guy. I say poor guy, I'm joking. He's 88 years old, and he just lost $20 billion this year. Think about this. 88. I bring it up because our friend Bill Cohan, friend of the show, he writes for Puck. He got him on the phone this week, and I wanted to. So let me just give people the background, and then I'll tell you what Carl said. Basically, this is a combination of poorly performing assets, like not making great investments, public investments or private. He owns Pep Boys and Amco, which are like, auto repair. He owns them wholly. He owns a sausage casing company. He owns the old AT&T office building in Atlanta, which has no tenants anymore. It's an empty building. So he's paying a huge dividend to attract new buyers to the stock. And a major short seller comes along last year and says, hey, that seems unsustainable, digs in and discovers the fact that Icahn is hugely leveraged with margin loans, and he's using that stock for collateral. The short seller points it out. The whole thing, the bottom drops out. The stock falls 80%. So as of 2015, this is Bill Cohen. Back in 2015, he was worth $24 billion. These days, it's closer to $5 billion, maybe less. And it remains under considerable strain. The stock has fallen 51% this year, down 84% over the last 5 years. Carl owns 85% of the company's stock. For a renowned investor, that's not a great fact pattern. The S&P at the same time is up 81%. So he gets Carl on the phone. This is what he said. There's one word, hubris. This is Carl talking. People are destroyed by it. I think it was hubris with me.
Wow.
It wasn't enough that I had a great paradigm that we did, and I was very good at it, which was go to a company, work with them, talk them into getting me on the board, sometimes do a proxy fight, sometimes be feared. I had beautifully worked it out, and then I decided that I could really figure out what the market was going to do.
Most important, Carl Icahn say, I can figure out what the market is going to do. That's why I never ever try to guess what the market is going to do. You can't do it. I mean, Carl Icahn can't do it. Warren Buffett can't do it. And here we see, hey, where do you think the stock is going to go? Who knows, right?
It's sort of crazy. And I realize now that's the dumbest thing you could do.
Wow.
So he's not admitting that it's a Ponzi scheme. He still thinks that the short selling reports are lies.
It's not a Ponzi scheme.
But
All right. Yeah. So that's what, again, at the end of the day, people like Carl Icahn, who has been in this business for almost half a century, when you become too big, when you think that you figured out that this is the stock to own, I'm going to go all in, markets have a way to humble you. Not the first time I've seen, and that's why I'm like always saying position size is way more important than trying to figure out which stock to own. Right? I see, you guys know, we talked about Palantir last year, 2003 stock was at $7, right? And could have backed up the truck on it, right? Could have made it 50%, 25% of my portfolio. And the stock is like up 7 times since we talked about it. But you never know. It could have gone other way around. So I see on Twitter a lot of folks all in Palantir. Great. Good for you. But you've just been plain lucky that you're all in on Palantir, right? Stock could have gone other way around. You could have chosen a wrong stock. Just because that you're lucky doesn't, and what's going to happen the next time? Let's say Palantir becomes a mature company. You try to find out the next Palantir, go all in, and luck doesn't work in your way. You know look what happened with Carl Icahn. He's 88 years old. He thought he figured out the market because he's been doing for 50 freaking years, and he leveraged up his investment, lost 80% of his wealth. So market will always humble you. Risk management is way more important in any kind of investing, and you don't have to outperform. Even if you get market returns by indexing, just don't do stupid things of trying to lever up or trying to go all in into a particular stock. It might work out 2 years, 5 years because you picked up a stock that done great. And when it doesn't work out, that's what these stories like Carl Icahn will come out. So I had bought IEP somewhere in around when it was around $50 or something like that, even before 2020. And then I got K1 from Icahn Enterprises, and then I decided, okay, I don't want to own IEP because it's gonna generate a K1, which is always a tax headache, right? So glad that my reason of not owning IEP was that it's a tax headache. And then I never, tracked what's happening to it, to this, but until, I listened to this podcast yesterday, and then I'm like, wow, what happened to Carl Icahn? Can you provide the original link to the podcast? It is The Compound and Friends, and it's the most recent episode of it's CNBC commented. Yeah, he Josh Brown is a frequent guest on CNBC. So this is oops, sorry, it went. Oh, let me just put it to all. Share with everyone. The Compound and Friends. That's the name of the podcast. This is the first time, very new to investing. Can I connect with this later? Yeah, send me a message on a meetup, and then I can point you out to maybe some session that I've done. If you're just starting on investing, maybe I can share those sessions with you. All right, so this is Carl Icahn, and that's what prompted me to come and talk about risk management. Because it doesn't matter how smart you are, but if you're not prudently managing a risk, you can just wreck your portfolio. All right, so let's talk about risks here. Okay. All right. Let me see the last comment. K1 is not that hard to report on tax return using TurboTax. The problem, say I go to a CPA to do the taxes for every K1. He'll charge additional whatever $25 because it's a new form, and you know, you don't even make. It's not like my 10% of my portfolio, right? I'm gonna, maybe if I make a profit, make $10 of a profit and pay $25 to file the tax. Not really worth it. K1 comes very late. 1099, you know, come pretty early, so you have to wait for a K1. Sometimes it has happened that I got initial tax return, I reviewed it, and then I get a new K1. I'm like, I'm not doing anything, which actually gives K1. So, and it looks like it saved me from IEP. Anyway, so let's talk about risk. We're going to spend maybe another 45 to 50 minutes talking about risk because it is the most important factor when it comes to investing. We just heard what happened with Carl Icahn. I hope you can avoid that situation if you manage your risk prudently. Risk is there everywhere, right? So playing football, American football, or if you're on, you know, driving, you're swimming, the risk is everywhere. We can't avoid each one of our daily activities have risk. Risk is, yeah.
We can only dream to be as rich as Carl Icahn in the first place.
It's, again, I think it's everyone is rich at their own level. Let me put it that way. One of the millionaires, few days ago, I finished a book called Everyday Millionaire. And if you look at it, and I think there are a few other books related to that, most of the millionaires come from very humble background, teachers, firefighters, they just don't do stupid things. So it's not just Carl Icahn. I think for me, my portfolio is as important as Carl Icahn's portfolio. Let me put it that way. So, all right. So let's go through the risk management. So risk is the ultimate test of anyone's investment skill. It is not hard to achieve investment return because the markets generally goes up. Right? 3 times out of 4, market will go up. Go back and look at the S&P 500. 75% of the times markets 75% of the year percent of the times you will have, and markets will be positive. Real achievement is achieving the returns with the less than the proportionate risk that you have taken, which no one bothers about it. We generally don't talk about, and I personally have been asked questions around, hey, you've been managing your own money. You can give to financial advisor. What's your return on investment? Someone actually asked me, what's your AROC? I'm like, what the heck is this AROC? Like, oh, hey, annual return on capital. Oh, wow. People create a new terms. And I was asked, what's your AROC? So don't ask just like, what's your return for the year? I actually don't really want to talk. I mean, you can't compare one's return with how you are doing. It's a very, very personal way. If you're investing in, you may want to have a lesser return because you want a lower risk. So someone who has got a higher return doesn't really mean that they are better investor. You always have to look at a proportional amount of risk taken, which is very difficult to measure. And that is why I don't want to compare. S&P 500 is up, whatever, 18%. I'm up 25%. I did great. Or S&P 500 is up 18.5% this year, and I am up only 14%. Oh, I did poorly. No, it is how, as long as your return are in line with what you are trying to do. Like I said, if tech is up this year, I'm not going to outperform the tech because I'm trying to contain my risk on tech. Right? And I'll be okay with it. But that's just me. You may not be okay with it, but that's just you. You may be trying to outperform it, or you're trying to build your portfolio and want to take a risk. I don't want to take that risk. Because, hey, this is how I need income to run my house. So my risk propensity to take the risk is different. Then what if I had, other sources of income? So don't just ask someone, what's your risk? Also ask don't ask someone what's your return. Also ask someone what's the amount of risk that you've taken to achieve that return. Okay. That's very, very important. So we're going to go through, and came from some of the Hallmark slides. We're going to go through 4 or 5 money managers and see, which one, if you were to give your money to money manager, I hope you don't have to. That's why you are here, so that you can manage your own money. But if you have to, which one would you choose? Money manager number 1, market is up 10%, manager is up 10%. Or market is down 10%, money manager is down 10%. Do you think this is a good money manager? I mean, you could just invest in index fund. Why pay up for a money manager? Because there is no alpha that is being generated. It's not doing anything better than what the market is doing. It's just flowing with the market. This money manager might be investing in S&P 500, and that's why it's performing exactly to the S&P 500. Not the money manager whom I would want to hand over my money. Number 2, market is up 10%, manager is up 20%. Market is down 10%, the same manager is down 20%. How about this? Would you want to give your money to this money manager? What do you think? This money manager also does not have any capability to select the right stocks. Just that he's more aggressive. He's kind of a levered up. Right? No good stock selection on his, but no alpha. It just have more beta. That's where the difference between the alpha and the beta of the stock is, right? He has probably more volatile stocks in his portfolio with beta equal to 2. So if the market goes up 1x or 1%, the portfolio goes up by 2%. So I wouldn't give this money to this money manager also. That's why if you want to look at a mutual fund performance, or if you want to look at a money manager performance, don't look at what they've done in the last year, right? Or don't look at just what they've done when the market was bull. They might have outperformed the market. Also see how they performed when the market was a bearish market. How much bearish or how much their portfolio went down, so that then you can compare, is money manager adding any value, or he's just either leveraging up or he's buying a stocks which are a little more volatile, right? So not going to get my money. Money manager number 3, when the market is up 10%, he's doing 5%. So I'm sure no one wants to give a money to that manager. But the market is down 10%. He's down less. He's down only 5%. So again, like money manager number 2, there is no alpha even this money managers are doing. Just that he's a little more defensive. Number 2 was more aggressive. Number 3 is more defensive. So if the market goes up, you don't go up that much. When market falls down, you don't fall down that much. It's like you're having a stocks in a portfolio in which the beta is 1/2, like 0.5 beta. And that's what now then it just works how the 0.5 beta portfolio will. So no additional alpha given by money manager, no value addition done by a money manager with respect to the market. Number 4, market is up 10%, manager is up 15%, and the market is down 10%, manager is down 10%. I think this is what everyone would want to give their money to. Hey, I want this guy. When the market is bull, he outperforms the market. But when the market is bearish, he doesn't lose that much amount of money. So then, yeah, everyone would want to give money to them. And I think that's okay. this manager is doing something, is adding value to the portfolio and not just, either levering up or by being too defensive or just buying the SPY ETF. It's doing something which is adding value to your portfolio. Final one, money manager number 5. Market is up 10%, it performs equal than market, and market is down 10%, he outperforms the market because it's down only 5%. Now, not many people would want to give money to this person because we generally focus on how much I'm making when the market is going higher, right? So the pet peeve of the of an investor is if you made 10%, if the market is up 10% and you made only 10%, but if your friend made 15%, that's like, that hurts a lot more than if market is down 10%, I'm down only 5% while your friend is down 10%, right? So this is not the style of investing that is mostly talked about or given preference. But I guess if you listen to Howard Marks, he says this is how they invest because market, 75% of the time market goes up. You don't really have to work really hard to outperform the market because if you just stay with the market, you're gonna have a decent returns. When the market underperforms or market is bearish, if you can contain your risk at that part of a time, that's all you need. Right? So again, I think 4 and 5 both are okay, depending on what kind of investor you are or where in your investing journey you are. Okay? Maybe when you're just starting off your investing journey, you want to accumulate and then you may be willing to take little more risk to get this, higher alpha when the market is performing better. Maybe once you have accumulated a wealth, then you have to preserve your wealth. You don't want to be Carl Icahn and give away all that. Then you may want to focus on money manager number 5. Saying, hey, it's okay. If I can make 10%, my life is set. I mean, Carl Icahn had $25 billion 10 years ago. He was set. He was like 78 at that point of a time. He was set for his life. You may be at a stage or your portfolio is like, look at your portfolio and say, if I can make 10, 15%, am I set for it? For rest of life? Yes. Then don't try to do stupid things which will give you 30%, but has a more higher risk that, hey, you could actually lose this amount of money if the things don't go your way. And I don't care how well you have studied the market or how well you have studied the company. I don't care about it. Even Warren Buffett can't figure that out. Carl Icahn can't figure that out. Bill Ackman can't figure that out. Who are you or me to figure that out that, hey, I know in and out of this company. So look at where you are. What is risk? Risk is probability of permanent loss of capital, right? The money is not going to come back. Or it also could be a probability of missing out. One way you could say permanent loss of capital, I'm just going to keep cash. Right? Yeah. But then you have a probability of missing out. You missed out on all the gains that you could have had. Right? Market is a 15%. Your portfolio manager delivered 5%. He'll get fired because that's a risk in his job. Right? This is a risk of opportunity or probability of missing out. And he's got a real implications that if you're a hedge fund manager, you could get fired because your other peers did 10%. You have underperformed your peers. Or the risk is sometimes you get forced out at the bottom. And then if you're forced out at the bottom because maybe you got a margin call, right? Maybe you are leveraging your account and you're forced to sell the stocks because you have to add in more capital. And then you turned your potential risk into a permanent loss because you have to sell it at the bottom of the market. Essentially, risk says we don't know what's going to happen. Right? That's what the risk is. I don't know. Tomorrow anything could happen on the market. And that's why when someone asks me, and this is I go to a social gathering, friends meeting, birthday parties, and all that. And they know that I focus on investing. This is like full-time I'm focused on. First question asked, what do you think about the market? Do you think it's too high? Or do you think next week is going to go up or down? I have no idea. And then they think that I'm blowing them off. No, I'm being realistic. We don't know every day. That's why it's so fun, because it's challenging. You don't know what's going to happen in the market. There's a range of outcomes, but I don't know where the actual outcome is going to fall. Range of outcome is, I can say market could be between plus 5% to negative 5%, right? Or plus 10% to negative 10% for the month. Where it will go, I don't know. I have no idea. And you have to be comfortable in investing without knowing what could happen for the next month, or for that matter, for the next year. I think I have a fairly high degree of confidence that for the next 10 years, probably market will be higher than where it is. And I'm not certain. I'm still have a high degree of confidence, higher probability. But could we have a lost decade? Sure. There have been times where the market has not returned anything for the 10 years. If you held the stock on X year, for the X plus 10 year, you're still at the same place. Those are called the lost decades. We haven't had any ever since the records have been kept, lost 20 years. So I think I have a fairly 99%, or let's say 95% certainty that we will, 20 years later, we'll probably have a stock market will be higher than where it is, right? Because it has never happened in the history of S&P 500 that it has lost money in nominal, right? Not inflation, but the nominal, that we have lost money in 20 years. 10 years, it has happened. So, but next what's going to happen? I think my range could be anywhere, like could be down 20%, could be down up 20%, who knows? So we know the range, but I don't know where it's going to fall. Risk means more things can happen than will happen. There are more possible outcomes. Future should be considered as a probability distribution and not as a fixed outcome that's destined to happen. So when I started trading or getting into options, that really helped me to become a better investor, because I stopped thinking about black or white. Stopped thinking about stock gonna go up or stock gonna go down. I became more of a probabilistic investor. What's the probability that the stock may be up? 70%? I'll take my chance. Or if it is 20%, probably I may not take my chance. So stop thinking, and that really helped me. If you looking at the deltas, took a few years to start thinking about everything in life as well as investment. Nothing is black or white. It's always the shades of gray, right? Think about probabilities always, and be comfortable in investing based on probabilities and not, I need to know for sure, is the stock going to go higher next year or not? Only then I'm going to invest. Then you'll never be able to invest. Is there a fair chance of probability you're looking at the business? I think there is a fair chance that stock, more than 50% probability that stock could go higher next year. But that doesn't mean the other 50% won't show up for the next year. It could, right? Knowing the probability doesn't mean, yeah, that's what I was saying. Knowing the probability doesn't mean that that's what's going to happen. If I'm selling a put at 30 delta, means I'm 70% probability that the stock will be higher than my short put strike. But that doesn't mean that in the next expiration period, it is actually going to be higher, right? Sometimes it happens that the 30% will show up, and then you have to manage your trade. A good book to change and start to change your way of thinking is a book called Thinking in Bets. Gosh, by Annie Duke. Okay, she is a PhD scholar who left her, I think, PhD in between, or maybe she did a PhD and then she went on to play poker. She became some champion in a world champion or some champion in poker. And then I realized why many of the great investors play poker. Warren Buffett play poker. Mohnish Pabrai play poker. Charlie Munger used to play poker. Howard Marks play baccarat. And when you listen to these investors, they say they don't play chess. Chess is a lot more complicated. Poker is not that complicated, but the chess is a deterministic game. It's all about if you do the computations, you'll know exactly where you're going to end up if you're playing chess. Right? And that's why computers can beat are good at chess game, because it's a deterministic. Poker is probabilistic. And that's why most investors, they love playing poker, because it helps them to think in a probabilistic way, and they become much more comfortable in taking the risk where you're not sure what's going to happen, and you still have to make the trade. So I think it was the day before yesterday, or maybe a few days ago. It was this week. I was reading about Susquehanna, and now I'm going a little, offbeat, but just came to my mind. So Susquehanna is a market making firm. So when you join Susquehanna, and there were the references about the folks who worked on it. It says, like after 5 o'clock, after the market close, you go in a room and then you play poker. Right? And then like bosses and super bosses will know, and they'll find the great people, great traders, based on how they also behave when you're playing poker, because it's just like investing. You have some cases, if you're managing a bigger portfolio, hundreds and thousands of dollars at stake. And you don't know, you're not certain of what the outcome would be, because when you're playing poker, the outcome is uncertain. Right? You may have a little bit probabilistic. You can count cards and come to some probability, but the outcome is impacted by other players also. So they say that build up the traits, which is very, very much required for investing. Coming back to this probability, knowing the probability doesn't mean that it's gonna happen. It's a probabilistic way. When I started my investing journey, this is what I used to subscribe to, is volatility a risk. And I think I also used to look at a VIX, and I think I've commented out, VIX is a risk we consider as a factor of risk, which is VIX means it's a lot more volatile. Or if you look at a stock and you look at the stock beta, higher the beta, more volatile the stock is. And traditional, if you do an MBA or if you read books around investing, they'll tell you higher the beta, more riskier the stock is. And I subscribe to that for many, many years. Right? That if more volatile mean more risky. Probably, I think I was wrong. More volatile the stock, does it make it riskier? No, ever since I started reading the writings of, let's say, Warren Buffett and other great investors, they don't think that the more volatile stock make it more riskier. The presence, the risk may not show up. So the risk may be there, but it doesn't mean if the stock is more volatile, it is more riskier. Look at this. If you consider risk is a permanent loss of capital, then this is not necessarily true. So now I don't shun the volatile stock thinking, oh, it's more risky. Yeah, there are more probability that you could have a 10% gain and negative 10% gain, but that doesn't mean more risky. If you're paid less for it, maybe it's better. Is risk quantifiable? Can you find out how much is the risk in a stock in advance? Or if you can, then you are the most sought after person in investing world, because we can't know in advance if I'm buying a stock, how much risk is inherent in that stock. I can't tell. The beauty is, even after the fact, can you tell that the stock that you bought was risky or not? This should be an easy answer. Even after the fact, let's say I bought a stock and a year later, the stock is up. Can I say that the stock was not risky? And the correct answer is no. The outcome doesn't determine whether the stock was risky or not. It is equivalent to saying, and when I was reading about this, an example came into my mind is, you're driving a car, which all of us drive, unless you're like, hey, I'm always gonna take Uber. You drive a car, you jump a red light, or you run over a stop sign, and you reach a destination earlier than whatever expected, right? You could say, hey, I did great. It's like buying a stock which has gone higher after a month. But was that a risky one? Hell yeah, your move was very, very risky. Just that the outcome was in your favor doesn't mean that the act was not risky. You jumping a red light was very, very risky. So even after the fact, you can't tell just based on where the stock has gone that was there a risk in the trade or not. And this is like mind-boggling, that risk is something that you can't tell before the fact because we don't have a crystal ball, and something you can't even tell after the fact that what you did was a risky or not, because you can't judge it by the outcome of it. Just that, thankfully, there was no other car that was crossing the intersection when you jammed the red light. If there was a car, you could have been dead. Right? So you can't say just because nothing happened to you, you reached your goal ahead of time, that your act was not risky. Okay, so you can't even tell about the risk even after the fact. Sometimes the risk is counterintuitive. Better safety gear can entice mountain climbers to take more risk. Every year after year after year after year, we have a better gears. We have more safety equipment, better carbines, better helmets, better ropes. Still people die on mountain expeditions because having that better gears make the propensity to take more risk. That makes the propensity higher. So there was an experiment done. I don't think I have that example, but I heard about it. Yeah. There was an experiment done in one of a European town wherein they turned off all the street lights, all the traffic lights. Okay? And to find out the behavior. And if you turn off all the traffic lights, you would expect that there will be more accidents, more people will die. But the actuality, they had a fewer accidents because everyone became risk conscious. Everyone knew that if you're gonna behave recklessly, you're gonna just die. So they took a risk off and it became much safer. So I'm not saying that we should now turn off all the traffic lights. Yeah, the life became slower. You won't be able to drive as fast. It will take more time to go. So there were other impact, but when it comes to the total loss, there are fewer total loss because you become more cautious because you don't have a safety net. Like if you don't have a safety net, you're not going to blow off all your money, right? If you don't have a social security, right from a day one of your earning, you start going to save because there is no social security. There is no safety net. So the risk is not in the activity itself. The risk is not in mountain climbing, but the risk is not in investing, but how we as an investor approach investing. Investing is not risky. Our behavior makes it risky. So if you can control your behavior, You probably can take an opportunity when the other participants are engaging in a risky behavior. Yeah, we just talked about. Risk is low when the market investors behave prudently, and it is high when they don't. I think I don't have to talk twice about it. Now tell me, which stock is riskier? Stock A or stock B? If you're new to investing, you ask anyone that says stock A is riskier. I mean, similar business, same fundamentals, or let's say it's the same business, but just that the stock price keep fluctuating because, hey, day-to-day stock price keep changing. Business doesn't change, but the stock price change. Give it this chart. Most of the people say stock A is riskier. Why is this going down? Stock B is good, less riskier because the stock prices continue to increase. Isn't that counterintuitive? Stock A is much less riskier. The actual is, it is much less risk in the stock A because its price is so low. It's the same business or similar business. There is a lot more for stock B to fall than stock A to fall. So the risk in the stock A is much less than the risk in the stock B. But it is counterintuitive. We don't view the stocks as that way. We kind of go, you know, if the stock is falling, we all think, oh, stock is too risky. No. A lot of risk has come out because now the stock is available at a cheaper price than where it was. Provided you understand the business. Provided you understand it's the same stock, just that the market has now decided to punish it. And now we have we can buy it at a cheaper price. It is less risky. Stock B got added more risk in it. Stock can go to zero. Obviously, both stocks can go to zero. But imagine you invest in stock B, or let's say same stock A at a different point. You have a lot more to lose than if you're investing in stock A. Risk is hidden and hence it is deceptive, right? Loss is what happens when the risk is the potential of loss, potential that it go down to zero. And it could stay inert for many, many years. Because something has to happen for the risk to appear, to show up. If it doesn't show up, that doesn't really mean that we did a great job. It just that means we didn't have an environment for the risk to show up. The example that I love giving is this. You build a house. It has got a construction flaws. Nothing will happen to your house unless there is an earthquake. Does that mean your house wasn't risky? It was damn risky. Don't blame the earthquake. Dude, you didn't do the right job. You saved money on your construction, on the foundation. You didn't use as good a foundation as you should have. And it worked because, hey, the rest of the environment was conducive to you. That doesn't mean that you were not at mistake and you now realize your mistake when there's a little bit of a tremor. The other houses are still standing, but your house is down because your house was more risky. Think about an investment the same way. I think I have an example right here. The investments that we did in 2020, and I've been guilty of that too, 2021, were risky investment, but the risk didn't show up because the market was favorable. We were having all liquidity coming from Fed. The interest rates were zero. We were even talking about negative interest rates. So everyone piled up on, including fund managers, hedge fund managers, individual investors. We all invested in Nikola at $50, $90, right? No one wanted to talk about whether the company has a revenue or not. Forget revenue, whether the company has a product or not. You're giving valuation of like $50 billion to the companies that have a product only on a paper. And we all thought we are great investors. Every individual investor, I know Chamath Palihapitiya, he made a statement that he is the Warren Buffett because he did so many SPACs. Right? The risk didn't show up until 2022 when Fed start to increase the interest rates. Now it determines what the heck I was thinking. Why the heck I invested in a company which didn't even have a product? But external environment was favorable doesn't mean that you didn't do a stupid mistake. You ran the red lights. Just that the intersection was clear at that point of a time doesn't mean you did the right thing. 2022, you see a Fed truck coming through because they had a green light and you ran the red light. What happened to your portfolio? It dead. So, risk is there, just that it didn't show up doesn't mean that we did the right thing. And I think a lot of investors have learned it the hard way. We all do mistakes. As long as the mistakes are not fatal, you are still fine. We talked about Chinese equities. Yeah, they are very cheap. But I'm aware of the fact that there is one risk on which I can't put any value. If I make Alibaba 50% of my portfolio, and Alibaba, like I think the market is expecting its fair value is $115, I look genius. Just because President Xi has not invaded Taiwan, that's why I look genius. Right? Doesn't mean that the act was actually a right thing. I mean, that it was the right thing to do. And I know of some folks who've gone too big on Chinese equities because it looks so cheap. And now they don't invest, are not in market anymore. Crypto hedge funds didn't realize the risk until Terra Luna blew up. Right? Or let's say many VCs didn't realize the risk until FTX blew up. So stuff happens everywhere, not just the stock investing, but everywhere. That's why Warren Buffett said, it's only when the tide goes out, we find who has been swimming naked. Just because you were covered by the tide doesn't mean it was the right thing to do. Right? I have nothing against nudists, but you know what I'm saying. Once the tide goes out, then you figure out, oh gosh, I've been caught. Right? Risk and asset quality. And this was really mind-boggling for me because I've only learned about this. And when I talked about this risk maybe a year or 2 years ago, I didn't have this slide in it. So I added it now. I've added many slides in today's presentation because, you know, I also learn, I bring up here. High quality is not always less risky. I also used to subscribe to the theory that pick up the highest quality business, you'll be fine. Then you learn some lessons the hard way, that high quality asset, high quality business doesn't mean that it is a less risky investment. There is a difference between a business and an investment. Investing in a high quality business doesn't always mean that it is less risky. Similarly, investing in a low quality business does not imply that it is a risky investment. Very, very counterintuitive. Because this is the other thing that determines the risk of investing. Anyone wants to take a guess? What's the other thing other than the quality of business? And I spend a lot of time in understanding the quality of business. But now I also want to pay attention to something else which determines whether the investment in that business is risky or not. And that other factor is, what are you paying for that investment? What's the price that you're paying for that investment? 2021, Tesla is a great investment. I mean, it's a great, oh, forget Tesla. Google was a great, Meta was a great business. They generate a lot of cash flow. Alphabet generated a lot of cash flow. Amazon was a great business. Even Tesla is a great business to own. From, you know, what are they doing for the future? But the investment in that great business was risky in November 2021. because the price that we were paying was just making it riskier. So asset quality alone does not determine whether your investment is risky or not. Nifty 50 of 1960s or 70s, all great businesses, IBMs of the world, Xeroxes of the world, GEs of the world, right? But they were priced high enough to make it very risky. Businesses wise, all great, high quality business, but are still very risky investment. FANG stocks became very risky. Still, businesses were great, but became very risky as an investment in 2021. And opposite, a low quality stock would be cheap enough that it's less risky. This is what Ben Graham used to do, right? Cigar butt investing is, hey, it has been beaten down so much that there is almost no risk, or the risk is very less in this particular stock. Maybe a low quality stock. That's how Warren Buffett started. That then Charlie Munger came and changed his way of investing, saying, let's not invest in low quality, less risky stock. Let's invest in a high quality businesses. But what they also did, which most of us didn't do, was how much are you paying for that high quality? I mean, we just forgot about what a pricing we're paying, right? In 2020, 2021, in 2000, we just forgot about the price. Any price is a good price, as long as it's a good quality business. And then we learn the lesson in a hard way. I've learned my lesson. You still keep learning in the markets. Okay. But now we realize that, oh gosh, prices that we paid for Meta in 2021 weren't that great, or for Google, etc., etc. So pricing, the price at which you buy the asset determines how risky the asset is. Another chart, risk-return relationship. This is what you see in a normal textbooks. Hey, higher the risk, higher is the probability of return, right? Higher the return. To make the higher return, you have to take a higher risk. Yeah, don't want to take any risk, keep money in your bank. You're going to lose to inflation. Oh, want to take a little risk? Okay, move into fixed income securities, buy some bonds, but you're not going to make a return because there is not much risk. Or want to make high return, invest in stocks. What the downside impact of looking at this chart is, it makes us think that if I buy a risky asset, I'm gonna get higher return. So in the book, I think the most important thing where I saw this chart from Howard Marks, which I really love, it changed the way how you think about risk. Higher return doesn't always mean, higher risk doesn't always mean higher return. Like buying all the high beta or higher risky stocks doesn't mean that you're going to get a high return. What it does mean that there's a lot more variation in the outcome that could happen. So if you've taken this is riskier stock, if everything falls in your favor, you're going to have a much higher return. But other side is also true. Less risk, you have a lesser variability in the returns. So this is where you have to start thinking in a probabilistic term. If things work out, it'll be great. But there are probabilities that the thing may not work out. So now you want to see how much you want to allocate to your portfolio at this level. If I have only this chart, which is how you generally think about risk, of go and plot a risk return, go and Google for risk return profile chart, you're probably going to see this most of the time, which makes you think higher risky investment generally give higher return. No, they have a more variability in the return. So how should the risk be handled? Risk is a possibility that from a range of possible outcomes, Like we've seen in a previous chart, there's a range of outcomes increases. Any unfavorable stuff will happen. So going back here, outcome range is higher here. Risk is that maybe I'm gonna have this outcome will occur, right? And if this outcome occurs, great. But there's a probability that my outcome could be this one out here. So I'm gonna lose investment. So that's the risk. It can consist of suffering permanent loss of capital. It can also be that you're missing out on a gains when a good things happen. So how should risk be handled? You need to constantly focus on risk, because you can't do, oh, you know what, I'm going to buy a truckload of puts when the market is going to go low. We talked about many times that buying puts doesn't work, because you don't know when the market is going to blow up. You don't have that crystal ball. Even you might think by looking at the charts that you can figure out. The reality is you won't know. Let's admit it upfront that, hey, it's impossible to know when the markets will blow up. So you should always constantly deal with how much risk you want to take in your portfolio. Risk management is something which is consistent. Risk control seems unnecessarily when bad things don't happen. That doesn't mean that it's a mistake to have it. Why am I gonna stop at a stop sign? There's no one out there. Or why I need to stop at a red light? There is no one in the intersection, right? There's no one on the other side. But you know, if you don't stop it, what could happen? You should still stop at the red light, even if you don't see anyone else on that road. Because one day, some truck will ram over there. So risk reductions should always be in place. Now you can determine based on where you are in your investing journey, or how much of money you've invested in a particular asset class. Then you can determine, yeah, maybe I can have a little more, I don't have to reduce risk by a huge amount, or whichever way. You can determine your quantum of your risk reduction based on your individual capability or individual propensity to take risk or individual situation. But risk reduction should always be on your mind. So how should risk be handled? In a superior portfolio, risk is always under control. Skilled investor assemble a portfolio that will produce good returns if things go well, and resist a decline if things go poorly. Right? This is like portfolio manager number 5. The asymmetry is critical element for superior investing. Hey, if the stock goes down, I'm not going to lose that much. You can't tell this based on a short-term performance. That's why I said, never look at what happened in the last 1 year, 2 years. You have to look at a performance by including some bearish periods also. Can you avoid risk? Sure. Don't do anything. Keep money. But it is not prudent. Avoidance of risk is not prudent. Management of risk, controlling the risk is what we should focus on as investor. So now I'm going to talk about various kinds of a risk that happens in a portfolio. Whether you are a retail investor, or you are a hedge fund manager, or you have a Carl Icahn size account, or you have a small account size like me, I think for everyone, your account size is all that matters. Doesn't matter whatever the amount size is. Right? We, as an investor, we cannot avoid risk because because inherently future is unpredictable, and hence the risk come out from there, right? If you can't predict, which you cannot, then that's where the risk is. So we can't avoid risk. We can choose what kind of a risk we want to take on. So let's look at various types of a risk, and also look at how you can mitigate some of the risk, because you don't avoid the risk. You can't. Can you avoid the risk in portfolio by not investing? No, because then you have a risk of not investing, which means it's a loss of purchasing power. Which means, oh gosh, I can't buy the house 5 years ago, and I kept all my money in cash. Let me just make sure that I have enough cash available, whatever I want to fund my retirement. And then you keep that money in cash. And when you're near retirement, you still don't have enough because you lost against inflation. That's a risk of not investing. Particularly relevant if you are only holding cash and only debt instruments, right? Your nominal value will not go down, but you don't eat dollar bills. We eat food. You will not be able to buy the same amount of a food in retirement if you have not invested in anything. Stocks, real estate, anything that it appreciates with value will offer you some protection against this inflation risk. So to mitigate against inflation risk is you gotta invest in financial assets. Now, if you're invested in market, what kind of risk you are exposed to? Equity risk, that we know. If the whole market goes down or your stock goes down, that's a risk. But that's a price we have to pay to get that extra return. If you are invested in bonds, which is a fixed debt instruments, then you run an interest rate risk, which is what a lot of bond investors figured out, including the so-called smart banks figured out in 2022. Once the Fed start to increase the interest rates, all the bond values went down. And we had a banks that kind of became bankrupt and went under. That's Silicon Valley Bank. There are many other banks because they held fixed instruments, the safest instrument in the world, treasury bonds, T-bills, and then they all went belly up because they were exposed to interest rate risk. So if you are investing in bonds and you think, hey, I got a bonds, I have nothing to worry about in my portfolio. No, you have to. You are exposed to interest rate risk. If you are dealing in Forex, or if you're invested in companies that derive a lot of their revenue from outside of a US, you're also exposed to currency risk. I own few companies, and then when I review the results, they'll tell you both. This is a dollar result, which is what matter for me because I need money in dollars. But they also report what your constant currency results are. Even though the constant currency results are good, hey, revenue was up 10%, profit were up 15%. When I look at the dollar terms, the revenue is down, profit is down, because it is exposed to the currency risk. What other kind of risk you have? You have a concentration risk of loss because your portfolio concentrated in one type of security, right? Amazon, Google, Netflix, add a few more techie stocks, Nvidia, AMD, like, hey, I got all different tickers. Am I diversified? No. You still have a concentration risk because these are all the stocks that move together. Google, Microsoft, Netflix, Facebook, they all kind of move together. You have to determine what's their correlation among them, right? You have to figure out what's the correlation before you invest. You could invest. So general wisdom is you should invest in at least 25 to 30 securities. What I want to add other thing is you should invest in 25 to 30 uncorrelated securities. Probably you may not be able to find it, but at least try to invest in as many uncorrelated securities as you can, because if you invested everything in all in tech, and God forbid you're retiring in 2022, you're dead. Now you have to, all the tech is down, QQQ is down 40%, and now you have to sell all your tech because you need money to eat. You're kind of selling at the bottom, right? So find uncorrelated. So diversify portfolio. Don't hold all tech or all energy or all metals. If you held all energy, you did great in 2022. But then you were dead in 2020. Energy stocks were down, no one was traveling. Crude oil went negative. The futures. At least own 25 shares. but then make sure you try to find as much uncorrelated. And that's the reason I still hold energy in my portfolio. Even though I don't understand the dynamics of energy sector, but I want to hold energy because it is an uncorrelated to the tech. Right? It's not that when tech moves up, energy moves up. No, this year energy is like one of the worst performing sector, but I'm still holding it because energy saved a little bit of my rear end in 2022. When the tech was all down, energy was the best performing sector. So you can find correlations on the websites, and don't invest everything, which are highly correlated. S&P and QQQ, IWM, highly correlated. Get some bonds, get some gold, energy. Find out the uncorrelated, get some materials, XLB. If you don't understand the individual companies, or don't understand the industry, like I don't understand the dynamics of the material industry. So I'll stick to their, let's say, ETF. And the beauty of investing in the US is you have an ETF for everything. So there is no excuse of saying, oh, I don't want to diversify. I don't understand which companies or how you're going to make money in energy. Yeah, don't make a big part of portfolio, just pick an ETF. You have a directional risk. Now, this is a little more tactical, right? We talked about during our option boot camp, you look at your overall delta of a portfolio, and then you basically manage the delta of your portfolio by doing delta reduction trades. So most of my trades, unless will be around delta reduction trades by focus on what your portfolio beta weighted delta is, and then you can use whatever QQQ, SPY, IWM, depending on what you hold in your portfolio to reduce your delta. More the delta, more is the risk. So if market rips higher from now, from here on, my delta is very low right now, and I'm not going to make that much. Like markets goes up 10%, the tech sector goes up 10%. I'm not going to make 10% on tech sector, but I'm fine with it because I've made enough gain. I want to just protect it. So focus on your portfolio beta weighted delta. So I covered this topic in a lot more detail around portfolio management using options in I think it was our 13th or 12th session of options bootcamp. You can go and see the recording of it on the website. Leverage risk. This is what killed Carl Icahn. Right? It doesn't apply to cash accounts, but if you have a $25,000 or more, you have a margin available on your account. So, but leverage cut both ways. It is good time, it will amplify the gain. Bad time, it amplify the losses. This is what Carl Icahn has gone through. He levered up on his investments, and now is down 80%. Mitigation. If you are option side, don't use more than 50% of your buying power. Or don't over allocate your portfolio. Keep some decent amount of a cash on the side. You never know where the market will go. If you are if you're levered up, your brokerage firm is gonna require more capital, and then you might end up into a situation where they are making decision for you and you are not making decision for yourself. That's why I don't like leverage. Keep dry powder on the side. Other kind of a risk is a tail risk. So this is a normal distribution curve, little bit of a high school math. Like the reason I love 70% is, one standard deviation. With the reason I want to sell it at one standard deviation, which is like your 16 delta, is 68.2% of the occurrences happen in one standard deviation. And that means if I'm doing a trade, I have a 70% probability of profit, which is decent enough. If you try to sell a strangle at 16 delta or one standard deviation out. I love that 70%. Most of the things in the life are normally distributed. Distribution of birth weight, right? Normal distributed. It's a random occurrence, but everything. SAT scores in 2010, normal distributed. You know, it's amazing how many of these math concepts, even the Fibonacci concepts, actually naturally occur in our lives. It's not that mathematicians have forced these normal distribution curves on us. No, these are how the things generally happen in life. And also in investing. Temperature anomaly distribution. Again, normal distributed, right? Normal distribution curve. Most of the time, things will stay within a range. And then you have a tails, which is like these things are far away are called tails. Very few things happen at the tails. Distribution of S&P 500 returns from 1960 to 2020. There we go, we have market data. Again, normally distributed. Most of the time, your return stays here. Nifty, this is daily returns from Indian Nifty. Again, looks like pretty normally distributed. Female shoes sales and the sizes, right? This I would say is normally distributed, but it does have some thicker tails. Thicker tails means, hey, if you go further out, it's not declining as in normal distribution. You still have some 2%, which is like 5 size, a little bit thicker tail. This is a normal distribution with a thicker tail. Heights of 14-year-old girls, normal distributed. Daily returns, I think this I picked from 2020, 2021. Maybe I should go and update it. Again, very volatile market. But if you look at it, normal returns in SPY, QQQ has thicker tail. Like this number of occurrences that happened outside is bigger than what's in on the SPY. That's a little more volatile. So when you talk about tail risk, this is what we're going to talk about. Multiple standard deviation move can happen, and it does happen, right? In QQQ, it has happened many times. And that's where nowadays we say those black swan events are becoming more common, right? Because markets have become a little more volatile. So you have a thicker tail of this graph of QQQ. It could devastate your portfolio if you're not either diversified, and this 4 standard deviation move that is not supposed to happen in few hundred years start to happen, and which is nowadays it's happening. COVID came in, stock was down in a month, not even a month. I think a few weeks, market was down 30%. How many times does it happen? But it did happen. We had like S&P 500 down like 5% in August, or close to 5% in August. And then again, it happened in September. But if you're building your portfolio, which is heavily exposed to the tail risk, that becomes a problem. So how do you avoid that? Stay small in some of those cases, right? That's why I want to do more trades. I don't want to do 10 contracts. If I'm doing an options, I don't want to sell 10 contracts of a short put of a stock at which I'm very bullish on. Even if I'm doing 70% probability, what if at that particular time or in that expiration period, I have a tail risk event that happens? There is no way I can predict the tail risk. There is no way you can control the tail risk. Only way to avoid getting devastated by the tail risk is stay small. I would rather do 1 contract of short put. More bullish, maybe I'll do 2. I don't want to do 10 contracts of doing a short put. That's where when you say, I'm going to go all in. Stock is so cheap. I'm going to go all in. How the hell you know that the next 1 month, stock is not going to fall to another 50%? The tail risk happens a lot more than what we anticipate. Only thing you can save yourself and your portfolio is don't go too big in a position size. When it comes to option, trade often. Instead of doing one trade for 10 contracts, maybe do 10 trade for each one contract each. 1 week now, do another week. Spread yourself. You don't know when the tail risk will appear. Sequencing risk. This is mostly because we do a lot of option stuff. I know it's a 70% probability of profit, but that doesn't mean that my first 7 trades is going to be profitable out of 10 and other 3 will be losers. It's like, I know if you roll the dice, it's going to be 50-50 head or tail. Doesn't mean that the first 5 will be head and other 5 will be tails. So you're on a sequencing risk. I have to be comfortable that maybe I do 5 trades, all 5 trades end up in 0. Right? Even though if those are 70% probability trades. Oh, yeah, 70-30 doesn't mean first 7 will be profitable. So don't go all in at a single strike price. Right? Ladder, because the market will move, you ladder the trade. This is equivalent saying, hey, don't do all trades at all once and let the probabilities work out. Time horizon. No one talks about this. Generally, financial advice, I mean, I've not seen investors talking about this, but this is a real risk. Because of unforeseen event, if you are forced to sell your stock sooner than you wanted, I'm investing it for my retirement. You and I, we all want to have a decent retirement. That's why we are investing. But what if I'm forced to sell my stock just before retirement? What happens? I have a time horizon risk. Gosh, I did everything right, but I'm now forced to sell it. And my time horizon of when I need money and the kind of investments I've done, they don't match. And when it comes to options, yeah, you did all your options with all the expiring next to each other, or you have a risk of outliving your investments. Or you did all your, I don't know, maybe all your fixed trades that you invested in CDs, all are maturing on close to each other. Gosh, you need to live after that also. Sovereign risk. Risk of loss when you're investing in foreign markets or ADRs. We talked about it. Government actions. Don't invest in any one country specific fund. RXX, which was a Russia ETF. I invested in it. When Russia's invaded Ukraine, the RXX was down like 25 or 50%. I'm like, so cheap. Thank God I didn't put all my portfolio money in it because, it no longer trades. So I have like all the money, I think I had the short put on it. It's gone, right? And I think probably I also had some stock, but it was a small part of my portfolio. Don't even have to, I don't even remember it unless when I'm talking about a sovereign risk, right? Don't hold only Baba, JD, Baidu, Didi, Neo, and all these. These are all Chinese stocks. And you have to be aware of that foreign risk. Counterparty or credit risk. This comes in because now a lot of these private investments, are becoming more and more popular. Or risk that a company on the bond will run into the difficulties and not repay the principal. That's when you have a counterparty risk. Look at the credit rating of the bonds. Or if you are dealing with the crypto, you can deposit your Bitcoin and they'll give you 5% per month. And these things have happened. Okay, these are realistic stuff that have happened in the crypto world. Right? But then you know what you're dealing with. Or if your friend is giving you an investment opportunity in which you can make 3% fixed return, sure, you'll make 3% as long as whoever is sponsoring that return doesn't go bankrupt. So you have a counterparty risk over there. So be aware of the counterparty risk. Right? This is a very tough risk to deal with, reinvestment risk. Damn, I had a bond, I had a CD that has matured. Now where I'm going to invest? So when you're trying to build your CD ladder or bond ladder portfolio, you run into this risk of, let's say I bought a CD or bond, which is maturing in a year. Then I bought one in a 2 year, right? What are you going to do when that matures after a year? If the interest rates have gone down, you have a reinvestment risk, because now you can't reinvest at the same higher interest that you were able to reinvest it when you initially did it. But it could go the other way around also, right? So it's a risk that you should be aware of. Risk also is there if you sell a security. And this is where I think when we are trying to take gains, selling is a more difficult activity than buying for me. Because not only that, I have to be right at two places. Number one, that the stock that I'm selling is not going to go further, continue up, that I look like a foolish. Number two, the stock that I'm going to buy is actually going to perform. So I've got to make two decisions. I have a reinvestment risk if I'm selling a security just because the stock has gone higher. You know, these are like that's why I hate those who call, I'm just a swing trade. Stock goes high, I'll sell. Stock go down, I'll buy. No, every time you are exposing yourself into a reinvestment risk. So, which is what to buy if you sell. Now I have to be right at two places. That the stock I sell doesn't go high and the stock I buy has to go high. Okay. Unexpected tax risk. Again, not many people talk about it, which is it kicks in if you sell a security. Right? And this probably comes in at the worst time. Hey, I got a margin call because of a too levered or whatever the reason. And my brokerage sold my Apple shares that I held it for 10 years. And now I have a huge tax risk that I need to worry about. Don't even think about this. These are all realistic scenarios. Don't even put yourself into a position wherein, hey, you will be forced to sell out of those and get into the tax issue. Most retail investors, including me, if you get into active trading, we don't think about taxes. Until we reach April and we are actually doing our taxes, then, oh, where do I get the money for taxes? I didn't give any money. That's why you get a shock in the March. So mitigation is, if you are selling any security at a profit because you held the security for long, make sure you move that cash into a separate account so that you have a cash to pay for it. Because the worst thing that could happen is you sold it now, incurred capital gain tax that you have to pay, and then you didn't keep that money aside. Come March, stock market is down. Now you are forced to sell other securities at a bottom or at a lower price. That's the worst of both worlds. So make sure you keep the cash aside. Keep an eye on how much is your taxable, how much is your realized gains are for the year, so that you can keep the cash aside. Or do a tax loss harvesting. So anyway, that's the end of risk stuff. And I think I got a call. Like I said, I have to hard stop. I have to go. So we'll cover those fallen angels next week. I need to rush out. So thank you for staying today. I hope, and I know it is not the sexiest topic to talk about risk, but believe me, if you focus on risk, market will take care of your portfolio. It took me a lot of time to understand it's a negative art. As long as I don't do stupid things to blow my portfolio, I'll be fine. But when you start investing, I used to think I need to find the best stocks. I need to find the next 10x stocks and end up taking up a risk to trying to chase those 10x that really didn't, doesn't end up in a good story then. So focus on risk. Okay. All right. That's my only last two words of wisdom. Risk management is very, very important. And it's like an oxygen, like cash is an oxygen. You don't feel the need of it until it goes out. You don't feel the need of risk management until the market starts to bite. So focus on this. All right. Thank you everyone for staying today. We're gonna cover the remaining topic of Intel and Starbucks in our next week session. I gotta go now. Bye-bye.